Usually when we look at the financial architecture of like a Michelin-starred restaurant, right?
Right, the really high-end places.
Yeah, the focus immediately goes to the main event, like, the expensive cut of Wagyu beef.
Obviously, yeah.
And the chef buys it at the prevailing market price, they sear it perfectly, and then they sell it for a premium. I mean, the highly functional, highly predictable business model.
It works. It's the standard.
Right. But the truly elite operators, like the ones pulling in these anomalous asymmetrical profits, they don't stop at the steak.
No, they use the whole animal.
Exactly. They take the bones at the market prices at near zero, and they roast them down for a premium demi-glace. They take the raw trimmings, render them into high-end tallow for the fryers, and through just, sheer brutal operational efficiency, they extract premium enterprise value out of every single molecule.
Right, out of the scraps, basically.
Yeah, so by the time they close out the ledger, they haven't just cleared the standard margin on the prime cuts. They've generated a total margin profile that fundamentally breaks the standard industry model.
Which is such a perfect framework for what we are looking at today.
Yeah.
Oh, absolutely. Because applying that to petroleum refining provides the exact lens we need. I mean, you're taking a raw, highly volatile commodity.
Right.
You're feeding it into a multi-billion-dollar, high-pressure, high-temperature chemical plant, and you're attempting to extract maximum economic value from, the resulting hydrocarbon chains.
It's intense.
It is. The margin for error is essentially zero. And the delta between an average operator and an elite operator, it's measured in the billions of dollars.
Billions. Which brings us to our mission for this deep dive.
Let's get into it.
Today, we are applying our talk ticker style analysis to Marathon Petroleum Corporation, ticker symbol MPC.
MPC, yeah.
We're tearing down their Q2 2026 earnings call transcript, stripping out all the Wall Street jargon, the corporate padding, and just pulling out a highly actionable, data-forward read on their operational performance.
And no fluff, just the actual number.
No fluff at all. And the headline numbers here are, frankly, they're staggering.
They really are.
We're looking at an EPS, earnings per share, of $17.73 for a single quarter.
I mean, for historical context, there are major S&P 500 industrials that would be absolutely thrilled to post that as a full-year EPS.
The full year, yeah, and this is just Q2.
Just one quarter.
And their adjusted EBITDA came in at $8.5 billion.
Wow.
And if we drill down into the core of the business, the refining and marketing segments of the R&M engine, that drove $6.7 billion of that adjusted EBITDA.
That's the lion's share right there.
It is. And when you translate that down to the operational level, it means they generated $24.84 of adjusted EBITDA for every single barrel of crude they processed.
Every single barrel. That's incredible.
But the metric that management kept hammering, and the one that perfectly mirrors that master chef analogy we just talked about, is their capture rate.
Right, the capture rate.
Yeah, MPC posted a 112% capture rate for the second quarter. And that's building on a 108% rate for the first half of 2026.
Which is just, beating the crack spread index by 12% is a massive signal of operational alpha.
Explain that for the listeners, the crack spread index.
Sure. So the index basically assumes a standard operating environment. You buy benchmark crude, you run a standard 3-2-1 yield, which is like 3 barrels of crude making 2 of gas and 1 of distillate, and you take the theoretical margin.
Like the standard recipe for the steak.
Exactly, the standard recipe.
Yeah.
So generating a 112% capture rate means Marathon's commercial and operational teams outmaneuvered the benchmark on both sides of the equation.
On the input and the output.
Right. On the input side, they sourced heavily discounted non-benchmark crudes. And then on the output side, they optimized their physical yield to prioritize whatever refined product was commanding the highest localized premium on any given day.
So they're making the premium demi-glace and selling it exactly when people want it most.
You got it.
So let's look at what is required to actually execute that.
Yeah.
Because the physical reality of hitting those numbers, it requires the hardware to be running at absolute peak capacity.
It has to be flawless.
Right. And MPC ran its U.S. Gulf Coast refineries at a 100% utilization rate this quarter.
100%.
Yeah, I want to pause on that because 100% utilization across a massive Gulf Coast footprint isn't just a matter of, leaving the machines turned on.
Oh, not at all. Running at 100% nameplate capacity in this industry means your entire reliability engineering framework is functioning flawlessly.
Because these are brutal environments, right?
Extremely brutal. Refineries are highly corrosive environments. They operate under extreme thermal stress. Components degrade rapidly.
Right.
So hitting 100% utilization means there were virtually no unplanned outages, no emergency valve replacements shutting down distillation units, and no supply chain bottlenecks choking the inbound crude feeds.
Which is almost unheard of.
It is. Management explicitly noted that year to date, they have recorded their lowest level of unplanned downtime of this entire decade.
That's a huge flex.
It really is.
Now, they did pull back slightly elsewhere. Like the transcript noted, the West Coast ran at 93% and MidCon was at 87%.
Yeah, but that MidCon dip was heavily telegraphed.
Yeah.
That was just planned turnaround and maintenance.
Right, routine stuff.
Yeah.
So the Gulf Coast assets were really the primary cash engines this quarter.
Absolutely.
But these outsized margins, they don't materialize in a vacuum. You don't clear $24 a barrel unless the macro environment is heavily constrained.
Right. And the transcript paints a pretty stark picture of the current structural deficit in global refining right now.
What are we looking at globally?
We are looking at a market where over 9 million barrels per day of global refining capacity is currently offline.
9 million.
9 million barrels a day.
So to contextualize that 9 million figure against, a standard baseline, how far outside the historical standard deviation are we actually operating right now?
We are roughly 4 million barrels per day above the historical norm for offline capacity.
Wow, so 4 million extra barrels just gone.
Just gone. That is a massive void in the global supply of refined products.
And the transcript points to two specific geopolitical catalysts driving this constraint. Really.
Yeah, it does.
First, there's the ongoing volatility in the Persian Gulf.
Right.
That has severely delayed scheduled maintenance and restarts for several massive Middle Eastern refining complexes.
Yeah, the logistical nightmare there is huge. You have rerouting of shipping traffic. You're dealing with spiked maritime insurance premiums. It's effectively stranded or delayed a significant amount of capacity over there.
And then second, we have the tactical strikes by Ukrainian forces on Russian energy infrastructure.
Which is a massive factor.
Yeah, the data cited in the call indicates those attacks have knocked out roughly 2.8 million barrels per day of Russian refining capacity.
It's staggering. That's a third of their total processing capability offline.
A third.
Yeah, a third. To the point where Moscow actually had to implement a full ban on domestic diesel exports just to keep their own internal economy functioning.
Oh, wow. I didn't realize it was that severe.
It's very severe. And the ripple effects of that 2.8 million barrel deficit, that's what ultimately drives Marathon's margins.
How does that connect back to the Gulf Coast, though?
Well, think about it. When Russia stops exporting diesel, the European market suddenly finds itself critically short on distillate.
Right, they need the fuel.
Exactly. So Europe then aggressively bids up cargoes from the U.S. Gulf Coast to fill that gap.
Oh, okay.
And that physical pull of product out of the U.S. inventory system, it drains domestic storage. The call actually highlighted that U.S. gasoline inventory is sitting well below its 5-year range.
Right.
And distillate inventory is scraping the absolute bottom of its 5-year range.
So that structural tightness is what creates the baseline elevated crack spread.
You got it.
But a high crack spread just means the water is warm.
Right.
It doesn't explain the 112% capture rate.
No, it doesn't.
To achieve that, Marathon had to aggressively manage their crude diet.
That crude diet, yeah.
And this is where the transcript gets super deep into their sourcing strategy.
It's fascinating stuff.
It is. They actively pivoted away from Brent-priced crudes, which were trading at a premium due to that Middle East risk premium we mentioned.
Right.
And instead, they targeted highly distressed, heavy, and localized barrels.
The commercial agility on display here is just significant. I mean, they doubled their intake of Venezuelan crude compared to the first quarter.
Doubled it. But Venezuelan crude is, well, it's not easy to work with, is it?
Not at all. Venezuelan crude is incredibly heavy. It's highly viscous, and it's loaded with sulfur and heavy metals.
It sounds like sludge.
It basically is. A simple topping or hydroskimming refinery physically cannot process it.
Why not?
It would destroy their catalyst beds. It would literally clog their piping.
Oh, geez.
But Marathon's Gulf Coast footprint includes deep conversion capacity.
Meaning what, exactly?
Meaning they have the massive coker units required to take that heavy bottom-of-the-barrel residuum and apply intense thermal cracking to it.
Thermal cracking.
Yeah, heating it to 900-plus degrees Fahrenheit.
Wow.
To break those heavy hydrocarbon chains into high-value diesel and naphtha.
And because so few refiners have that kind of hardcore hardware, Venezuelan crude prices at a huge discount to Brent or WTI, right?
Exactly. And Marathon captures that massive arbitrage spread.
Making the demi-glace from the cheap bones.
Exactly like the bones.
And their appetite for heavily discounted raw materials extended way beyond South America, too.
Oh, yeah.
They ran record volumes of Canadian heavy crude, specifically Western Canadian Select, or WCS, right into their Gulf Coast system.
Yeah, the transcripts flagged that WCS was trading at a $14 discount to WTI during the quarter.
$14 a barrel.
And the forward curve has that discount widening out to $16 by Q4.
When you're processing hundreds of thousands of barrels a day, a $14 to $16 structural discount on your primary feedstock, I mean, that is an enormous cash flow generator.
It's massive. Marathon has strategically positioned itself as the largest consumer of Canadian heavy barrels in the entire U.S. market.
Which takes a lot of infrastructure, I'd imagine.
It does. They have the pipeline offtake agreements and the specific blending capabilities required to handle that crude grade at scale.
And I noticed they also capitalized on some localized distress on the West Coast.
Yes, the Los Angeles situation.
Right. Their Los Angeles refinery, LAR, they doubled its intake of domestic California crudes.
Which was a very opportunistic play.
Because recent regulatory pressures and margin compressions essentially forced a few of their direct competitors in California to just shutter their refining operations.
Right. They just closed up shop.
And that created an immediate localized glut of California crude with nowhere to go, which effectively crashed the regional price.
And Marathon's commercial desk just stepped in.
Swept up those distressed barrels at depressed valuations and fed them directly into LAR.
It's a textbook example of capitalizing on competitor attrition.
Absolutely.
They essentially monetize the regulatory environment that put their peers out of business by absorbing that stranded feedstock at a massive discount.
But perhaps their most aggressive commercial maneuver this quarter involved the Strategic Petroleum Reserve.
Oh, the SPR play.
Yeah. This was such a fascinating detail in the transcript.
It really stood out.
So the Department of Energy has released around 110 million barrels from the SPR this year, basically to try and cool down benchmark prices.
Right. Gas prices at the pump.
Yeah. And historically, when those releases happen, major commodity trading houses act as the intermediaries.
They act as the middlemen.
Right. They bid on the SPR barrels, they take physical delivery, and then they resell them to the refiners, capturing a nice little margin in the middle.
Standard Wall Street setup.
But Marathon bypassed that entire ecosystem.
Which is wild.
They stepped up as a direct counterparty to the government, buying exchange barrels directly from the SPR.
And cutting out those trading houses completely changes the economics of those barrels.
How hard is that to actually do?
It's very difficult. It requires a highly sophisticated internal commercial desk that can manage the complex logistics, the marine chartering, and all the exchange mechanisms directly with the DOE.
So you have to do all the heavy lifting yourself.
Exactly. But by internalizing all of those functions, they secured highly advantaged economics on tens of millions of barrels that fed directly into their Gulf Coast and Mid-Con systems.
Okay, so this all sounds amazing, but I have to push back on the prevailing narrative here for a second.
Okay, let's hear it.
I'm looking at this operational data, and I'm looking at the macro environment, right? You have a war in Europe taking 2.8 million barrels of Russian capacity offline.
True.
You have a conflict in the Middle East trapping additional capacity.
Yeah.
You have local competitors going bankrupt in California, handing MPC cheap crude on a silver platter.
Also true.
And you have the U.S. government strategically flooding the market with 110 million barrels of SPR crude that MPC just happened to be in a position to absorb.
Right. This
looks like a historic confluence of macroeconomic luck.
I see where you're going.
I mean, as an investor, it is very difficult to underwrite a 112% capture rate as quote-unquote sustainable operational skill when the external environment is literally handing out massive structural advantages left and right.
It's a fair critique.
How much of this 8.5 billion EBITDA is actually repeatable alpha, and how much is just catching a once-in-a-decade geopolitical tailwind?
And the analysts on the call actually pressed management on this exact distinction between environmental beta and operational alpha.
I bet they did.
The geopolitical tailwinds are undeniable. They established that high baseline margin. But the ability to capture 112% of those margins, that is highly defensible operational skill.
Defend it for me. What makes it skill?
Consider the physical flexibility required to actually execute this strategy. The planning executives highlighted that their refining network is engineered to process over 100 distinct grades of crude oil.
100 grades.
Yes. Most specialized refineries are locked into a very narrow feedstock band. If they deviate even a little, their yields completely collapse.
So they can't just pivot.
Exactly. If a standard refiner sees a $15 discount on WCS or distressed California barrels, they often just can't capitalize on it because their metallurgy or their desulfurization units physically cannot handle the properties of that crude.
So Marathon can buy it because they built a machine that can eat it.
Precisely. Marathon's capital allocation over the last decade has been hyper-focused on expanding that exact feedstock flexibility. They can rapidly adjust their crude slate based on real-time pricing signals because they have the hardware to support it.
Okay, makes sense.
But the real defense of their operational alpha is on the product yield side. The crude diet is only half the equation. You have to look at what they are actually producing.
Right, the output. The transcript talked about the Garyville facility in Louisiana as the prime case study for this.
Oh, Garyville is a perfect example. It is one of the most complex refining assets on the planet. During Q2, the commercial desk identified a massive spike in the profit margin for jet fuel.
Just specifically jet fuel?
Specifically jet. Distillate and gasoline were strong, but jet demand in June pushed that specific crack spread to near record highs.
Okay, so what did Marathon do?
Marathon didn't just passively accept their standard product yield. They had recently completed a targeted capital project at Garyville specifically designed to enhance product flexibility.
So they tweaked the machine.
Exactly. Because of that investment, they were able to dynamically adjust the distillation cut points and the catalytic cracking parameters to increase their total jet fuel yield by 3% year over year.
3% might not sound like a lot to a layman, but pushing a specific product yield up by 300 basis points across a facility the size of Garyville.
It's massive.
That's a huge volume of highly profitable fuel hitting the market exactly when the premium peaks.
And that isn't an isolated event, by the way. Since the start of 2024, they have engineered their total system jet yield capability up from 8% to 12%.
Oh, wow.
They are actively identifying the highest margin product in the market and physically twisting the dials on the refineries to produce more of it.
Twisting the dials. I love that.
Yeah.
And they use some pretty advanced tech to do that, right? The transcript mentioned digital twins.
Yes, management spent time discussing their deployment of digital twin technology.
Which is what exactly?
They've built comprehensive virtual models of their physical refineries. This allows their engineers to simulate the exact thermal and chemical reactions of running different crude blends and altering yield profiles before they ever introduce the physical hydrocarbons into the actual units.
So they run it in a video game, essentially, before they do it in real life.
Basically, yeah. And that drastically compresses the decision-making loop.
Because instead of spending weeks analyzing the chemical feasibility of a new distressed crude cargo,
right?
They just run the simulation on the digital twin, confirm the margin expansion, and clear the commercial desk to execute the trade almost instantly. Okay, that validates the skill argument for me. The macro environment absolutely provides the opportunity, but the digital modeling and the physical hardware flexibility allow them to capture it at a rate that peers simply cannot match.
That's the alpha right there.
Which leads directly into how management is viewing the forward curve and what they are signaling to the market about the sustainability of these margins.
Right, looking ahead.
The critical phrasing from management on the forward outlook was their projection of an, quote, enhanced mid-cycle environment, end quote, which they expect to persist through the end of 2026 and well into 2027.
Let's translate that. In the vocabulary of Wall Street earnings calls, mid-cycle is shorthand for normalized baseline operations.
Like average.
Average. It implies a reversion to the mean after a period of extreme volatility, but by attaching the modifier enhanced to the front of it, management is quietly broadcasting a very aggressive structural thesis.
What are they actually saying?
They are telling institutional investors that the current elevated margin environment isn't a temporary cyclical peak that's about to collapse.
Right.
They believe the structural deficit in global refining capacity, that 9 million barrel per day gap we talked about, has established a permanently higher floor for crack spreads.
They view this high margin environment as the new baseline.
Yes.
And we can verify their conviction in that thesis by tracking their capital expenditures, right?
We always follow the money.
Exactly. Because if a management team internally believes they are sitting at the absolute peak of an unsustainable cycle, What do? They hoard cash.
He's batting down the hatches.
Right. They pay down debt and brace for the margin collapse. But Marathon is doing the exact opposite.
The exact opposite.
They are accelerating their capital deployment, but they aren't deploying it into vanity projects or massive new refining capacity.
Wow.
They're directing heavy capital flows straight into their midstream logistics segment.
And this is a crucial strategic layer. MPC owns MPLX, which is a massive midstream operator.
For our newer listeners, break down midstream real quick.
Midstream represents the critical infrastructure of the energy grid. So pipelines, storage terminals, fractionation facilities. It is a toll road business model.
Toll road, right.
They don't take direct commodity price risk. They generate fee-based revenue based purely on the volume of hydrocarbons moving through their infrastructure.
It's highly predictable, super insulated cash flow.
Very insulated. And during the call, management announced a massive $500 million upward revision to their 2026 capital growth budget for MPLX.
$500 million more just added.
Bringing the total expected midstream capex up to $2.9 billion for the year.
Deploying nearly $3 billion into midstream infrastructure while you are simultaneously printing record refining margins? I mean, that is a highly calculated move.
Extremely calculated.
Where exactly is that $500 million in accelerated capital going?
They are heavily targeting natural gas and natural gas liquids infrastructure, primarily bridging the Permian Basin to the U.S. Gulf Coast.
Got it.
They specifically noted pulling forward capital that was originally slated for 2027 to aggressively accelerate a major Gulf Coast fractionation project.
Okay, moving things up on the timeline.
Yeah, and they also provided updates on the Blackcomb natural gas pipeline, which is tracking to hit full commercial service by the fourth quarter.
Blackcomb, right.
Plus, they're pouring capital into their Titan facility in the Permian, expanding its sour gas treating capacity to over 400 million cubic feet per day by year end.
Okay, so the obvious question for a retail investor holding MPC equity is, why should they care about aggressive pipeline buildouts in West Texas when the core business is refining heavy crude on the coast?
It's a great question.
The answer lies in the financial architecture between MPLX and Marathon and the explicit distribution targets management laid out on the call.
Right.
They stated that this accelerated capital program is designed specifically to support a 12.5% annual distribution growth rate for MPLX through 2026 and 2027.
And because Marathon Petroleum is the parent company and holds a massive ownership stake in MPLX, those distributions flow directly up to MPC's balance sheet.
Like a massive dividend check.
Exactly. By engineering a 12.5% annualized growth rate in midstream distributions, Marathon is effectively constructing a multi-billion-dollar, rapidly compounding annuity.
That's a great way to look at it.
It establishes a massive defensive cash flow floor that protects the enterprise, regardless of what happens to global crack spreads.
Because even if refining margins completely compress,
the toll road revenue from MPLX just continues to flood the balance sheet with cash.
But it's not just a financial hedge, right? There's a massive operational synergy at play here, too.
Oh, definitely.
During the Q&A, an analyst pressed the commercial executive on the rationale behind focusing so heavily on natural gas logistics from the Permian to the Gulf Coast.
And what did they say?
The executive outlined a major structural bottleneck in the current market. Permian natural gas is incredibly cheap right now, sometimes even pricing negatively due to lack of takeaway capacity.
Oh, right, they just can't get it out of Texas.
Exactly. But getting that cheap gas to the industrial consumers on the Gulf Coast is currently constrained by pipeline limits.
And refineries are massive consumers of natural gas.
Are they? I didn't realize they use that much.
Huge amounts. They use it to generate the intense heat required for distillation and thermal cracking.
Oh, like heating the cokers up to 900 degrees.
Exactly. And they consume massive volumes of it to produce the hydrogen needed for hydrotreating and desulfurizing those heavy Venezuelan and Canadian crudes we talked about.
So they need the cheap gas to process the cheap crude.
Yes. So by building out the Blackcomb pipeline and expanding that fractionation capacity, Marathon is vertically integrating their supply chain.
They are breaking the bottleneck to ensure that hyper-cheap Permian natural gas flows directly into their own Gulf Coast refining complexes.
Which is brilliant. They are effectively using their midstream capital to structurally lower the operating expenses of their refining segment.
Which will just drive that 112% capture rate even higher.
Exactly. And the capital discipline surrounding these projects is rigorous. The CEO explicitly stated that their internal hurdle rate for all new refining and logistics investments is 25%.
A 25% hurdle rate. That's steep.
It's very steep. If a project cannot model a 25% return on invested capital, it just doesn't get funded.
Oh, so they're not allocating capital just to grow the footprint for the sake of it.
No, every dollar deployed must meet a severe efficiency and return threshold.
Which brings us to the ultimate metric for any equity holder.
The bottom line.
The core of our talk tickers analysis. Capital return.
Show me the money.
Right. We have dissected the capture rate, the geopolitical macro environment, the distressed crude sourcing, and the aggressive $2.9 billion midstream expansion.
We've covered a lot of ground.
We have. Now we have to look at what they are actually doing with the resulting cash pile. And the data from this transcript supports a highly bullish stance on the underlying equity.
The magnitude of the cash generation here gives management incredible optionality. I mean, they generated $6.6 billion in pure operating cash flow in the second quarter alone.
$6.6 billion in one quarter.
And that excludes favorable changes in working capital.
With $6.6 billion in operating cash flow, they can fully fund their daily operations, easily cover that massive $2.9 billion MPLX capital budget, pay out their standard baseline dividend, and still have billions left over.
Billions.
To just aggressively shrink the float.
Yeah.
That is exactly what they executed.
It's the most important number in the transcript for a retail investor.
Which one?
The $2.8 billion of capital returned to shareholders in Q2.
Yeah.
Digging into the composition of that $2.8 billion reveals management's view on their current valuation.
Break it down.
$2.5 billion of that total return was executed purely through share repurchases.
Allocating $2.5 billion to buybacks in a single quarter. I mean, that is a massive statement regarding their cost of equity and return on invested capital.
It is. Because when a company is generating peak cycle cash flows, the market often applies a depressed multiple to the stock, right?
Because they anticipate that earnings will eventually revert to the mean.
Exactly. The market assumes the good times can't last, so the equity trades at a discount to its immediate cash generation.
So management is looking at their internal 25% hurdle rate for new projects.
And they're realizing that buying their own stock at this depressed multiple actually generates a far superior risk-free return on capital.
Retiring $2.5 billion worth of shares permanently reduces the outstanding float.
Permanently.
Every share they retire permanently increases the free cash flow per share for the remaining equity holders.
It makes the underlying stock fundamentally more valuable without relying on any sort of multiple expansion from Wall Street.
And they're doing this continuously. During the Q&A, one of the analysts noticed that despite the aggressive buybacks, Marathon still has a massive cash balance just sitting idle on the balance sheet.
Right. The cash pile is still huge.
The analyst actually asked if management was signaling a defensive posture by holding back cash instead of deploying 100% of it into the buyback program.
And the CEO's response was immediate and unequivocal.
What did she say?
She clarified that their capital allocation priorities have not shifted. Aggressive share repurchases remain the absolute priority for excess cash.
So why the temporary cash build?
It was just sheer timing mechanics combined with a fiscal obligation to eventually repay the government for those SPR exchange barrels they utilized this quarter.
Right, the SPR barrels.
The underlying mechanism is clear, though. The $6.6 billion operating cash flow engine is intact, and the buyback program will continue to aggressively shrink the float.
The transcript also contained a brief but pretty important update on their renewable fuels segment, which operates under a completely different economic reality than the traditional refining business.
Very different.
They noted that following a major turnaround at their Martinez renewable facility, utilization jumped to 95%.
That's a good jump.
And the segment's EBITDA actually increased by $277 million year over year.
But the tone regarding renewables was notably cautious compared to that aggressive midstream expansion we just talked about.
Why cautious?
Because the market for renewable diesel is currently heavily oversupplied, and margins have compressed significantly across the entire industry.
Oh, I see.
Management made it clear they are maintaining strict capital discipline in this segment. They are deploying capital solely to optimize the efficiency and yield of their existing assets, like the Martinez facility.
But no new mega projects.
Absolutely not funding blind capacity expansion. They are essentially putting the segment into a holding pattern, just waiting for regulatory mandates to catch up and normalize the market dynamics.
Specifically, they're waiting on the EPA's, quote, Set 3 rule, which is going to dictate the renewable volume obligations for 2028 and 2029.
Right. Until those regulatory mandates force demand higher and clear that supply glut, Marathon is just refusing to burn capital chasing growth in a compressed margin environment.
It's another clear indicator of a management team operating with extreme capital discipline, rather than just chasing ESG narratives at the expense of shareholder returns.
They are maximizing the cash engines that are working right now, complex refining and midstream logistics, and aggressively defending the balance sheet against the segments that are currently facing structural headwinds.
Which perfectly sets up the final critical analysis we need to do, because we always want to leave our listeners with the edge of the cliff.
A contrarian view.
Right. We have laid out a massive bullish thesis today.
We have.
MPC is generating $8.5 billion in EBITDA because they can process cheap, heavy Venezuelan and Canadian crudes through highly complex hardware, all while 9 million barrels per day of global refining capacity is offline due to geopolitical chaos.
They are the elite operator functioning at 100% utilization while the rest of the market is structurally broken.
But as an investor, you have to look at the fragility of the macro environment propping up those margins.
You do.
What happens if the geopolitical landscape unexpectedly normalizes? What if the conflict in the Middle East miraculously cools down and those delayed mega refineries finally come online and just flood the Asian and European markets with product?
Or what if a ceasefire is reached in Ukraine and the Russian energy infrastructure is repaired and brought back online much faster than the market anticipates?
Exactly. If that 9 million barrels per day of offline capacity suddenly rushes back into the global system.
The structural deficit evaporates overnight, product inventories will spike, and the crack spread benchmarks will violently compress.
Furthermore, if the global supply of refined products normalizes, the fierce competition for feedstock is going to intensify.
Oh yeah, those steep $16 discounts on Canadian heavy crude or distressed California barrels. They'll evaporate as other refiners suddenly have the capacity to bid on them again.
The enhanced mid-cycle thesis that management is banking on relies heavily on the assumption that global refining capacity remains structurally constrained for years.
For years, yeah. If that thesis breaks, the baseline margins driving that massive cash flow engine will revert to historical norms much faster than anticipated.
So, while the 112% capture rate and the aggressive $2.5 billion buybacks make this an incredibly compelling equity to hold right now, the actionable homework for an investor is clear.
Do not take your eyes off macro data.
Keep a close watch on global refinery repair rates, Middle Eastern infrastructure timelines, and any signs of geopolitical detent.
That 9 million offline barrel figure isn't just an interesting data point. It is the ultimate leading indicator for Marathon Petroleum's future cash flows.
When you see that 9 million figure start to rapidly shrink, you will know the competitive environment is normalizing.
And the anomalous margins are on borrowed time.
Monitoring the velocity of that returning capacity is exactly what separates a reactive participant from a highly informed capital allocator.
Well said.
Keep tracking the data, watch the global capacity numbers, and we will see you on the next deep dive.